Big SPAC news today. FinTech acquisition announced today that they would be merging with Eturo, the crypto trading platform. You see in the article I'm going to pull up right here. Trading platform Eturo to go public via SPAC merger and $10 billion deal. Multi-asset investing trading platform and Robinhood competitor Eturo announced Tuesday it will go public via merger with Spac FinTech at a value of $10.4 billion. Compared to 2019, when the average registered is 192,000, they grew to 440,000. So this is a very fast-growing platform with 20 million registered users from 100 different countries. So yeah, there's big potential with the growth in cryptocurrency. And what Eturo allows you to do is allows you to follow people that trade for a living. So you could basically copy their trades in the cryptocurrency, and it ranks the traders and whatnot. I have not become a member of it yet, but I was looking to sign up, and I'm gonna take a look at the Robinhood. It's up 42.76% today, and I'm gonna show you how I kind of find these SPACs. I go to barchart.com, I go under stocks, I go under SPAC stocks, and then I like to filter by volume for the day. So volume, and you can see Churchill Capital, the CCIV's already merged or already announced they're going to merge with Lucid Motors. Then we got FinTech acquisition that had the most volume today, and you can see it's up 49% over 5 days and 42% today. And you can also go to performance, and you can see how much it's changed as well. These are all warrants. You don't really want, that's why you want to look at the volume, but that can give you another idea of what SPACs are performing. But when you see a big jump in volume, you could just go to Google, type in FTCV merger or whatever SPAC seems to be running that day, and then you usually can pull up an article to telling you why that SPAC is up big today. But it lets you know basically on that first day what merger is taking place. So that's kind of how I look at getting into it. And let's look at the chart. This is a 30-minute chart. So it pretty much ran up all day, traded flat, ran up, and then hit a peak at about 1575, then dropped back down and ended the day pretty neutral. So it's looking like it's peaked right at 1570. So it might pull back slightly, or it might just open gap up depending on, traders' interest. Let's look at the after hours. After hours, it's down 6.15%. So it might be a chance to get on a pullback. But I'll probably pick up maybe 100 shares when they have options, do some cover calls against it or whatnot. But I've already gotten into IPOE, Social Capital IPOE right down here. It's already up to 1845. I already got a long-term 2-year leap option on it, and so I'm kind of overextended on the fintech, but this might be a good opportunity to get into a solid fintech company, before they run up. It might run up to $17-18 when they finally do merge. But yeah, with crypto and with all the stocks kind of linked to crypto, they have a lot of volatility in them, and they're great for selling options. So that's another one we'll put on the list of stocks to potentially sell options against when it starts having options. And also I'm in Futu, which had an earnings today, which crashed a little bit. So I'm pretty overextended in fintech. But Coinbase, I know, is doing an IPO. Let's try to look up Coinbase IPO date. Coinbase hasn't provided an official date for the IPO, though existing share. Can you make coin investing in Coinbase? Coinbase valued at $100 billion at IPO. It really might be too expensive. I know they talked about shares being around $380 or somewhere around that when it goes to IPO. So it might be really, really expensive. But like I said, these stocks are really volatile, and they give you an option to sell options against, basically, or even do calendar spreads. I've been experimenting with calendar spreads. I even want to do one on Roblox, because if we pull up Roblox, it'll be a chance to get into the option potentially cheaper. So if we look at all available options, if we go April 16th, I'm looking at the $100 strike price. If we sell the front end option at $585 and go to October and we buy the back end option at $20.75, that's 25%. So 25% of this option will pay for, May, June, July, August, September, October. So 6 months. So you're getting 25% off for 6 months. So 1 month pays 25% off the 6 month period you're going to hold this option. So, it might be a cheaper way to get into, especially if you think it's going to run up and not get past 100. But another trick is, if it does get past 100, either you have the option to buy it back, which is going to cost you, or you can roll it over to the next month and kind of have it keep as a rolling debit spread. But it caps your potential gain, but it allows you to gain an option play cheaper with more time. So if it doesn't get to 100, if it gets right at 100 and maybe 99, that's like the ideal for a calendar spread, because then you've gotten into it at a cost basis of below $15. But if it drops and the back end option actually loses value, what I would like to do is I would go in and I would sell it, and I would move down my strike price. So say it stays at $80. You could always move down your strike price, and it will only cost you $1.25 to gain $5. So the further out the option is, the less it costs to move your strike price down. But the closer the option is to expiration, the more it costs up front. So that's why you can kind of roll around your spreads using these calendar spreads and these what they call diagonal spreads, where you're selling the front end option and you have a back end as collateral. But the only time that this really works against you is when you have something that just spikes wildly in one day, and that option you sold becomes in the money. You never let it become in the money. You sell or roll it over. But yeah, that's when it kind of works against you, and you wait for a pullback to buy it back, or you move it forward a date. I'll show you that later. But yeah, I might buy this and set up a video to monitor it. I'm still working with this. I've kind of experimented with this with Futu, which is going fairly well. I'm kind of, because the Futu bounced back so strong, I was able to lower my strike price from 190 to 135, so that when it did bounce back, I made a lot more money. But I sold options against it, and I got kind of caught in that spring back to where I had to roll the option over to April 16th. And now that's down a little bit, I might buy it back or might roll it forward. So I don't know what I'm going to do, but I'm trying to kind of play with this, get a feel with this, mix this with candlesticks, so that I have a system that you're taking very, very, very little risk to get an option trade long term. And if you feel like it's about to hit a home run, don't even sell options against it. This is when it kind of trades sideways to reduce your cost against it. For those days when Neo is just going sideways, or AMD is a perfect example right now, where AMD is just trading sideways for such a long time that you're losing money on your back end option from time decay, but you're using these front end options to kind of neutralize that time decay. And because that time decay, you have a lot of distance away. So if you buy a year out, that time decay is a little bit of money, just a little bit of money. And if you sell these front end options, you collect that little bit of money to offset your time delay. And if it comes down to maybe 6 months out and it hasn't made the move, you could buy more time. or you could just exit the option. So that's kind of what I'm playing around with right now. I'm using the Motley Fool picks. I signed up for their newsletter. I think it was like $90 for the year or something like that. I got on one of these sale days, but they've had really good success last year. They picked Tesla around $90. So if you could get one of these home runs and you do it with a leap option, you can potentially make, like, if the time they called out Tesla at $90, your option probably will cost you about $3,000 for a year. And by the time the end of that year, it would have been worth about $65,000 on that run. So even though Tesla ran, I think it was like 700 or 800%, your leap option would have made you 3 times that amount just because of the option leveraging 100 shares for a cheaper price. That's why I've been preferably using leap options, and I'm kind of trying to sell, but the selling kind of caps you off, but reduces your risk at the same time. So I'm kind of trying to strike a balance between the two, and I'm working on creating this system just by experience. I'm going through and buying these spreads and stuff and getting in trades a little bit cheaper and then holding them. If you got in, like, say a month ago, you put on one of these calendar spreads, you would have gone to the option a lot cheaper because the market crashed, so that front end option would have expired worthless, and you would have used that to pay for your back end option. So you can't do it all the time in a major bull market. You probably want to avoid it. But if you look at the candlestick charts as a guide, use delta 20 or less, preferably delta 10, 15. It's not that much money. But if you use week out options, you can always roll it over if it comes out. But I'm trying to work out the math and trying to get a sense of what type of options these work with. And I'm picking options that have 100% of their at the money. They're at the 100% level as far as their basis for the year. And what I mean by that, I use bar chart again. Options. I go to options. I go to IV percentile rank. And I go to see IV rank or IV percentage. These are pretty much almost the same, but IV rank is the at the money average implied volatility relative to the highest and lowest values over the past 1 year. If IV ranks 100, this means that the IV is at its highest over the past year. So basically, it's the most expensive option on the front end you can get, meaning that your front end option is going to pay 25 to 30% of your back end option. So sometimes, and IV percentage is almost the same thing. You could use these almost interchangeably, but usually this happens when there's a huge move in the stock, or it's a biotech stock that's up. I try to stay away from biotechs with this type of strategy because they're all over the place. But yeah, you can see Lordstown Motors, because this is potentially fraud going on here, so you got to do a little bit of news, but that's why that IV would be so high. It's uncertainty, basically. Discover I'll just click on it and show you. It's probably something that spiked. You straight parabolic growth. But this one's, wow. This one's kind of interesting because it's kind of stepping. It's nothing like straight news related. So this might be an interesting stock to put on your list because it's kind of stepping up along. You can see that the averages are moving along. It's not like parabolic like this. So yeah, I wonder what this company does. But anyways, Eturo is coming out public through a Spac, so it might be something to put on your watch list.